Geopolitics have dominated headlines and markets through the first quarter of 2026, first with U.S. actions in Venezuela, then more recently by the ongoing military strikes in the Middle East. And this most recent conflict has led to a lot more volatile markets as traders work to digest the daily developments to energy production and general supply flows through the key shipping choke point of the Strait of Hormuz. But market destruction hasn't been on the scale of what we've seen from historical conflicts, as it seems that investors remain optimistic that both sides will eventually come to an agreement and de-escalate. And when it comes to geopolitical scenarios like this, our expertise does not lie in the short-term trading, nor in making bold bets on policymaker decisions, but in looking out over the months and years ahead, resisting the urge to overreact to headlines and maintain our disciplined focus on economic fundamentals. So oil does remain a vital global commodity and the lifeblood of many industries, and higher oil prices can make transportation and power generation and even everyday products more expensive. But our economy is a lot better insulated from shocks such as this than in the past, thanks to greater diversification of energy sources and higher oil production domestically, and a transition toward just less energy intensive sectors like services. So over the past few weeks, the price of oil has remained in a range of 90 to $100 a barrel, which is up from the 60 to $70 a barrel that we saw pre-conflict, but still below the highs of about 120. And it's important to remember that there have been multiple time frames just in recent memory, such as the early 20 teens and 2022, where oil did reach these levels. And notably, neither of these periods ended in a recession. So, as we consider the economic fundamentals today, the US consumer entered the period on solid footing, stable real wage growth, relatively low unemployment, and modest levels of household debt, all supporting that. And leading economic indicators such as the Manufacturing and Services Purchasing Managers Index signals an economy that is moderately expanding, certainly in line with long-term trends. So while pockets such as housing remain weak, little in the current economic environment suggests a fragile economy that's really prone to spiking energy prices. And as we have highlighted in many of our conversations with you, as well as recent writings, equity valuations were stretched entering 2026. So with that in mind, we started the year by increasing portfolios, adding to previously unloved sectors such as energy and materials that have supported portfolios through the volatility that we've seen so far this year. And with equities priced to perfection, any pullback was not going to be surprising this year. And it just so happens that a Middle East conflict was the thing that set it off. And it's important to remember that, these corrections are healthy for markets. And it's common to see intra-year declines like this, even in years that ultimately ended up positive. So we remain vigilant in assessing the dynamic situation in the Middle East, and are certainly prepared to adjust portfolios if necessary. And for now, we wish you a happy and warm start to spring.